Hello, everyone, and welcome to Jim Dalton's presentation, the Intensive Preparation Part 1, Fast Track. Thank you all for being here today after a long, busy market day. It is 4:30 p.m. Eastern, May 20th, 2015, and I think we're settling in here. We are recording this. I'm going to try and load it immediately following because I have to go out, so it should be up within an hour or so after we complete the webinar. And with that, I will turn it over to Jim Dalton. Hi, Jim.
Hi, thank you very much. As always, things happen in the marketplace, and sometimes we vary from the schedule. We're going to do a little bit of varying today because so many of the things that we will be talking about in the intensive occurred today with the S&Ps. We have a document that will be coming to you tomorrow. Those are the people that are registered for the intensive. We have labeled it Fast Track, and what we have tried to do is go through that document and give you a thumbnail sketch of the very important concepts that we will be discussing throughout the intensive. And it's fast track, just like you would think going on to a freeway or something else. It's the fastest way to get there. It's a document that you'll have with you, and it's a reference document. A lot of times, you want to say, what's he talking about? Let me see what that is, and you'll be able to go to this document and get a little more explanation of what something is. What I want to do is share with you the very first paragraph of that document. I'm going to read it to you in its total context. It's titled Exactness Kills. Most of us would enjoy some exactness regarding where we enter and where we exit a trade. Unfortunately, it doesn't really work this way. That is not to say that there aren't occasions when the references become quite clear. However, if this exactness were commonplace, the algorithms would have already identified and picked them off in millionths of a second. That is not an exaggeration. Whether it is a static reference, which is a reference identified from previous market activity, or a dynamic reference, which develops more on the fly during the trading day, it is the context surrounding that reference that helps us assess the odds of the reference being reliable. It is being able to understand this context that gives us a clear edge over the algorithms. And I'm going to go and I'm going to show you that exact comment in a minute. A lot of times I hear traders say they can't, the reason they're losing is because of the algorithms. I think that's an excuse. I think there's actually, the algorithms, in my opinion, give us an edge. And the reason for that is the algorithms are very mechanical and price-based. I just finished reading a whole book on it's called Dark Pools, which you may want to read. Gave me a pretty good understanding of the algorithms and how they work. And incidentally, in a way, they're like Pac-Man because one algorithm eats up another algorithm. Okay, so the first thing that I want to address, I want to go to today's market. I want to go to a reference that we had coming into the day. And I want to show you how understanding the context was very valuable this morning. If you will look at the two red lines.
Jim, excuse me, can you just close your time template so it's a little less distracting? No, the left arrow, there you go. Thanks.
Okay. This is what we called a buffer last night. The lower number is 21.2075. The upper number is 21.2125. Now let me show you how we arrived at that number. It was the top of the lower distribution when the market broke out to the upside on Friday and gave us a double distribution day to the upside. The second number was yesterday's low. Anytime you break out, they have an upside breakout, the level that the market broke out from becomes support. The ideal upside breakout would be demonstrated in the double distribution day from Friday that you see on the left. We would keep this double distribution, and then the market would build value above that. Not just that day, but going forward. The closer the market retreats to the original breakout level, the less dynamic I would expect the breakout to be. Yesterday's low was just a couple ticks above the breakout level that we're using. So that was why this was the reference, or what I called it, a buffer zone this morning. And the idea being acceptance back below the buffer zone puts us back into the previous distribution, which would be negative, which would reverse the upside breakout. So we would have an upside breakout failure. And a lot of times that works. Now, what happened this morning, there is a period. A period opened, and we're going to take a much closer look at A period in a few minutes here. But A period opened. Confidence was not high. I'm going to show you in just a few minutes.
Excuse me, sir, just the green dot is the open.
The green dot, it opened, and the unchanged level from yesterday was 21.2450. Within the first half hour, we traded every 5-minute period at unchanged level. Either one time it was only one tick below it. That is not high confidence. When you trade 6 times, then the first half hour back and forth through unchanged, that is not high confidence. That tells me that any break we were getting this morning was the result of short-term liquidation versus something that would be more sustainable and more meaningful, which would be a combination of new money selling and short-term liquidation. Okay, we're going to go into this in more detail when we get to the slides. But the point I want to make is this was not high confidence this morning. The volume on the first half hour, so attempted direction was down. The volume on the first half hour was low, and on the chat comment I said the volume did not support the break. So where I'm going with this is while we had a reference beating the buffer between 21.2075 and 21.2125, and we got acceptance down there over time, over 2 periods, I was not going to be short down there because of the context, not because of the price, but because of the context. You'll see it more fully when I show you some slides later. But the confidence wasn't there early in the morning, and the volume didn't support the break. Additionally, another chat that I put out said, and this was yesterday's low, if you get a break below a previous day's low, you would prefer that the market, once it gets below that, continue lower. It may sometimes check it back up, go in there and check the market one time, but not very often. A lot of you that have been with us for a long period of time probably remember I was out in Napa Valley. We were doing a week-long seminar, and one of the comments I made out there, one of my favorite trades is to go, in this case, long with a market that looks outside of a previous day's range and comes back in. And so this morning, I was putting the chat out and saying we would prefer the market not to come back into yesterday's range. And it kept ticking one tick below it, one tick below it, many times. That's not going to hold. We got back into the range, and of course, you can see what happened the rest of the day. My point is, before we go in more detail, my point is that an algorithm may have shorted this market. We may have shorted the market, but we came out and exited out of the trade because the context did not support the downside breakout. Very important concept, and I go back, and you can compete against the algorithms, and I believe that they actually give you an advantage. Okay, the document that we're talking about will be, hold on, how do I, slideshow?
From current slide, or
there we go.
There's the icon next to it. Yep, thanks.
The fast track document will be available tomorrow. I think Julia will distribute it tomorrow. It is going to be a work in process. We have other information that we're going to add to this, so you'll get this document. It's several pages, but then you'll continually get a revised document as we update. For example, one of the articles that we're updating right now is on acceptance and rejection. Another is on the use of stops. So again, this is a very valuable document. It's called Fast Track. Julia will get it out tomorrow. Okay, let's go to the official presentation, and then I'm going to go back and cover today's market pretty closely, because many of the concepts that are discussed in these early slides in preparation for the intensive were very applicable in today's market and extremely helpful. We talk about the intensive as being immersion learning. One set of learnings, we could teach everything by a deck, what am I trying to say? Flip charts and things like that, and be very static and very linear through the process. I don't think you really can learn to trade in a linear manner. One of the things that we talk about is when you trade, you are against professionals all the time. There is no starting place where we have junior tournaments, amateur tournaments, beginners, intermediate, or any of that. It's 100% full time. So what we are doing, we are immersing you. We are starting by taking each day at a time and just starting that day, immersing ourselves in that day. And as I see that plunge into each day, you get the ripple effect. This kind of hit us the other day. We get into the market in the morning. We'll see that when we talk about today. And then we get these ripple effects that go out. You just saw one of them. We went down, and we started off within yesterday's range, but we went down and got outside of yesterday's range. We got back into a previous trading range, and that invoked all other types of concepts. Look outside and fail when you come back in. So it's never a simple process, but we're going to start each day, immerse you directly into the market, and then we will work outward from there, going with and learning as each day goes on. And this is the reason that we have the chat feature, the one-way chat, where I can make chats all day long, and we'll cover several of those as we get to today's market. You have two basic courses of action as the market opens. In some cases, the markets have confidence from the opening bell. In these instances, we want to act immediately. Other times, the market lacks confidence. In these instances, we have to remain mentally flexible and ready for anything. We have to be prepared to react. Today was a great reaction day. Those are two totally different forms of action in the morning. So many times, traders get themselves in a lot of trouble because they're too anxious to trade early. Granted, sometimes you should trade early. Other times, you are far better off to wait and let additional information develop. Everything takes place from the open. Do we open in balance? If we open in balance and remain in balance, and the closer we are to the middle of the range, the greater the odds are that we are going to have a rotational environment and we're going to have smaller opportunities. If we open in balance on the middle of the range, what we want to do, if we open near the edges of the range, it may be a little bit more dynamic. We may have to trade a little earlier because you're on the verge of being out of balance. But if you open with imbalance, which in the someplace in yesterday's range, the closer to the middle of that range, the less likely you are going to want a trade early. The odds are more than likely going to be better if you wait and trade later. If the market is out of balance, the opportunities are usually much larger and you generally have to act much quicker. So this idea of, not doing the same thing every day, too many people are geared up, they're anxious, they're overly anxious to trade in the first few minutes, their adrenaline's pumping, and tremendous number of mistakes are made from people that trade early. On the days that you need to act, there are good opportunities. In the days that we're in balance, the opportunities, they're more likely you're going to get chopped up. Okay, and then we have, of course, the larger opportunity would be out of balance, which would be a gap situation. And as those of you that are prepared for the intensive know, we have the gap trading rules. If you're outside, if the gap does not close fairly quickly, then you want to go with the gap. If the gap does close, then the second rule is if value isn't going to develop to at least unchanged, which means overlapping yesterday's value area, then more than likely you're going to get a counter auction later in the day in the direction of the original gap. So gap trading rules, when we have a gap that is the maximum, we are out of balance. As you know, we've talked before, and just to prepare yourself for the intensive, the larger the gap, meaning the more out of balance we are, the lower the odds that the gap will be closed, the greater the odds that the market will continue in the direction of the gap. That is a very difficult concept for people sometimes, because the larger the gap, the more their impulse is to fade the gap. The reason the larger the gap, the lower the odds that the gap will be filled, is because the larger the gap, the more dislocations from people that were either long or short, depending on where the gap was, and have to correct their positions. So there's the bigger the gap, the lower the odds that the gap will be filled. Counterintuitive, but you'll find there's a lot of things that are counterintuitive to be a successful trader. The most important thing we deal with is confidence, and we want to start reading confidence from the opening bell. And I'm going to show you an example in a minute that within a very few minutes, there's days when I will have a pretty clear idea of what I am dealing with, at least for the first part of the day. And let's talk about that confidence. Here is the opening from yesterday, May 19th. The market opened, you can see the arrow is circled. This is in 5-minute bars. I don't recommend you using anything other than a 30-minute bar. I only use the 5-minute bar in order to make this point. Here's the opening, and the line right here, the red line at the 2126 level, is unchanged from yesterday. The opening is right up in here. The market goes down to unchanged. We get a bounce, comes back up above it, it goes down, it comes back through it. This is 5 minutes, second 5 minutes, 5 minutes, 5 minutes, 5 minutes, 5 minutes. 6 times within the first half hour, this market traded it unchanged relative to the previous day. Additionally, the market is in balance relative to the previous day. So we said the more a market is in balance, the lower the opportunities, followed by confidence. When this market trades at unchanged or the settle from the previous day 6 times in the first 30 minutes, this is 6 times using a 5-minute bar. It was far more than that. That is a low confidence market environment. When you have that kind of environment, what you want to do is you want to sit back, you want to take your time, and you want to pick your spots. High confidence is different. This was low confidence. When we talk about defeating the algorithms, this is part of it. Oh no, they get cut up on the low confidence days. Take a look. Now let's talk about confidence again, another aspect. We were using a reference from the previous day, which had been May 18th. It was a double distribution day, trend day to the upside. Those of you may recall that we treat each distribution of a double distribution day as a separate day or auction. So in other words, a double distribution day is 2 separate auctions. If I'm using this treating this as a day, my references for this day would be the daily high at 2128.75 and the low of the distribution, which would have been at 2122.25. But if you see the white line right here at 2122.50, that white line is the halfway point of the entire distribution for the day of the 18th. We know that when a market trades to unchanged, when a market trades to half back, we know that's an indication that the market is being controlled or dominated by the day and short-term time frames. Longer-term money, and this is in the written up fairly well in the fast track document, longer-term money has no idea where halfback is, nor do they care. And then you can say this, well, what do we care about who's buying at halfback or who's buying at these levels? We care because when the buying comes from exactly halfback or a tick from it, we have the buying taking place by day or short-term traders, which are the most fickle and weakest of the trading community. They are the ones that, you'll see them get inventory out of balance very quickly. You'll see positions reverse. They're very fickle. Longer-term money doesn't reverse their positions nearly as quickly as this. So when I look at this day, I say early in the morning, the A period low was a single tick below half back. We had identified half back as support in the morning. So this goes down and it's a single tick below half back. Now at that point in time, you might say, okay, we have a single print buying tail. I would say yes, at that point in time, we have a good low because it's got single tick buying tail. But we would also say we have a weak low. We have a weak low because it is a single tick away from half back on the previous day. When I look at that and I have a weak low, it's information I carry forward because I know that there are greater odds that the market will come back to that weak low prior to the end of the day. Does it have to happen? No, but I know there's good odds that it might. At the same time, when we're always talking about this idea of confidence, if I have a weak low, this was a good low, remember, because it has single prints, but it's a weak low because it was within a single tick of a reference. When it's within a single tick of a reference, that tells me that the buying there was very mechanical, shorter term traders, the weaker sub traders. So I carry that information forward, and with that information, I know it reduces the odds that I'm going to get sustainable day-long activity to the upside. Remember, it's odds. It doesn't say there's zero. It just simply reduces those odds. Okay, so that's early in the morning. We chopped around. We said 6 times through unchanged in the first half hour. That is not a sign of high confidence. We saw that the first period low was a single tick below half back from the previous day. It's a weak reference. So when I go further into this day, more than likely I am dealing with a relatively weak day. On a weak day, I may get constant rotation. Get inventory gets too long, get inventory gets too short, and I'm looking to take smaller opportunities multiple times rather than looking for larger opportunities. Okay, here's the same day. Here's the same day in a larger perspective. Remember, we opened within the previous day's range, and the reason it's the previous day's range, it was this upper distribution of a double distribution day. We treat each day as a separate day or auction. We open within it. We have a weak reference. Early morning reference was 1 tick below this, so that's good odds that we come back to that reference before the day is over. Doesn't have to happen. And you'll see that the market traded around until late in the day. Late in the day, the market traded above the upper distribution of the previous day. Now, when this market trades above that distribution, it was only 1, 2, 3, 4, 5, 6, 7, 8. The point of control was already 8 wide at this level. So when this market trades above this level, that reduces the odds that you will get upside continuation. Remember, we had a weak low down here in the morning. That reduces the odds of upside continuation. So the market breaks out on the upside, and what does it do late in the day? It fails. It breaks out in I period. It comes back in. Here's the previous day's high at 21.2875. Some people will short it as we come back in to the previous day's range at 21.2875. I forget what price I put on the chat. I was 21.2775, was I not, Julia? I think I was.
Sorry, it's a new mic. Yes, yeah.
Okay.
In the morning report, it was 21.2050, I think, but on the last night's report, 21.2175.
Okay. So as this market broke to the upside, we have another document that Julia put together, and it's called our. I'm sorry. What's the actual name of it?
Signature Trades Worksheet?
Oh, signature trade worksheet. One of the signature trades on that worksheet, we saw it yesterday, you're going to see it again when I talk about today, was look outside of range and fail, or look outside of balance. This was a balance day, look outside and fail. When it comes back in, that is a short. Now, Julia would have shorted that up here a little bit higher. My price was a little bit lower. I wanted to see it come back into this early morning range. But whichever way you did it, as you can see, we got the liquidation yesterday afternoon. Okay. Did we have any sense that this could be coming? The answer is yes. We had a weak low in the morning, but you were all day long before that weak low got taken out. But it is a piece of information you carry forward. The market was 8 wide before it broke to the upside, which reduces the odds that you're going to get upside follow through. When you have a prominent point of control at 8 wide, it usually takes substantial volume in order to maintain the upside breakout. This market, as you see, came back in. There was reasons to be thinking that it was going to fail based on the poor low in the morning, a weak low in the morning, based upon how fat this market was, based upon lack of confidence, and the market did. Once it came back in, that was a pretty nice trade on a liquidating basis. Now the question always comes to people, so well, where would I short it and where would I put the stop? As I read you the first piece, I can't tell you exactly where you're going to short it and where you're going to put the stop. I like them when they come back in and close. In this case, they have the potential for double distribution. I like them when they close that double distribution. You're going to see that when I go to today's market. You're going to see a chat we put out this afternoon. But when we review this day, we start out in the morning. We had we opened within range. Okay, when you open within your range, that should mentally prepare you that it's going to be a smaller day. Your need may not be to trade as early, and you may see smaller opportunities, and you take your trades faster. So we had low confidence. We were in the previous day's range. We had all indications it was going to be a rotational trading day, which it basically was until you got an attempted breakout in the afternoon. Now, we said early on that the smaller opportunities occur when the market opens in balance. The larger opportunities occur when the market opens outside of balance or looks outside of balance and fails. If a market looks outside of balance and fails, the destination trade is the opposite extreme. And that is one of the classic trades on the signature trade worksheet. We started off within the previous day's range, which we were using the second distribution of a double distribution day. The highs and lows of that are pretty much the range that you would like for any day. We looked above the previous day's high. We failed. We looked outside of the range. We failed. The destination trade becomes the opposite extreme. It made that opposite extreme yesterday. Okay, that's just all I'm doing in this case is just giving you some idea of what we want to do on the intensive. We want to take and work with you on every single day. And as you saw, the ripple effect when you drop something in the water, how the water ripples out. As we ripple out and catch other of those concepts, we will incorporate them within the context of any given day. Okay, Julia, let me stop right here and take any questions about how we will conduct the intensive just based on what we have talked about to this point today. There's a lot of other things we haven't addressed, such as what the market looked like coming into the day. Right now, I just wanted to take these small pieces.
Okay, Jim, thank you very much. We have a couple of questions from yesterday, but you want to keep it on, today. You want to keep it on yesterday's?
Yeah, I want to keep it on what we've talked about so far because this is the preparation for the intensive.
Okay. Sure, and we got a question from Steve here. For the failed breakout in I and J periods, do you wait until the end of the J period to take the short?
No. And again, that's what I said earlier. There's no exactness to it. And I can't tell you where you would get in and where exactly you would put the stop. Once it re-enters, and this is part of, I said we're adding a piece to the fast track document. It's called acceptance or rejection, and it's going to help clarify that point. It's when you come back in and you start to, you'll get a feel. Trading is not a science. There's still artwork about it. But let's talk about the factors that would not require you to wait until the end of J period. We've already identified those. Remember, trading is about odds. So Oh, what did I do? Okay, we already said that we had a weak low in the morning. So if you're thinking about putting that trade on when it re-enters, one of the pieces of information you should be carrying with you is I have a weak low from today. Now, I know people that got that trade short and they got out a little early because they forgot about that. It's hard to remember that. So that would be one. Secondly, we know we had low confidence all day. The lower the confidence, the lower the odds it's going to continue. Secondly, we had a POC, point of control, that was 8 wide prior to the breakout and the failure. So those things add up. Those things add up to increasing the odds. First of all, they lower the odds that the market will not have a sustainable move to the upside. Remember, just odds. It doesn't eliminate them. It lowers them. Consequently, once you come back in, it increases the odds that the market can do substantial liquidation. So again, rather than just mechanically say, do I wait to the end of J period? When you consider the context, you say, what is the context? And when you see what the context is, you're probably going to be a little more willing to enter this trade earlier rather than later. If you had a very high confidence day and you just dip back in J period, well, now I may be a little more hesitant. This was not a high confidence day. So again, it's understanding the concept. Once you understand the concept, it will be easier for you to make that decision. Do you or do you not want to enter into that trade? Okay, another question related to what we've talked about. That was a good question. Thank you very much.
Yes, thank you. In the first 30 minutes, do you wait to see if the market breaks out of value before deciding the nature of the day? In other words, if it's rotational or trending?
No, I don't wait till it breaks out of value, to be out of range. No, I am starting to make an assessment of the confidence from the opening bell. For example, if we open and we trade back and forth through the opening multiple times, guess what? Do I have a high confidence day or a low confidence day? More than likely, I have a low confidence day. Like yesterday, it traded every 5 minutes at unchanged from the day before. I have a low confidence day. That is how much confidence I have surrounding the opening is going to have an awful lot to do with what I want to do today and how I see the day developing. And that's, again, the importance of the immersion, that if you're going to be a successful trader, it's not going to be by the numbers and by mechanically looking at references. Would you buy a piece of fine art that was painted by the numbers to hang in your home? More than likely not. And it's the same thing here. Anything that was painted by the numbers or trade by the numbers isn't going to get you where you need to be. If by chance that worked, it would be arbitraged away immediately by the algorithms. The real advantage, the real advantage that we have over the algorithms, and what I think they work for us, is to understand the context underneath the market. Okay, another question before we move on.
Yes, thanks, Jim. The IJ period, would you consider taking a long from the I with the I breakout here, or was the point of control and the fatness of the profile something that would override a breakout trade?
Great question. And the question, it's a wonderful question. And the answer to the question relates to your mental flexibility. I believe in yesterday's situation, it was a legitimate trade to take. The market broke early, and it balanced, when it balanced here for 3 periods. Balanced here for 3 periods. And one of the other things that occurred yesterday, take a look, the previous day's high was at 21.2075. E period was just, is E period 1 tick or 2 ticks short of that? It's 1 tick, right, Julia?
2 ticks, as I remember it yesterday. Yeah, you got 2.
Okay, and so it's a good high because it's got two single prints, but it's certainly not a super high. So when this market balances for an hour and a half, the two most important concepts we deal with are excess and balance. When you come out of this balance,
Three inside bars. Yeah.
Three inside bars. No, they're not all inside. But three very balanced bars. That is a legitimate trade to go long. Now, because you're a breakout from balance. Now, some people say, yeah, but it's so close to the high. That's right, and there's reasons not to do it. But it is a legitimate trade. The more something is balanced, the greater the odds that you're going to get a decent pop when you come out of balance. When you come out of the balanced trading rules are as follows. If the market is balanced, stay within balance, look above the balance and fail, look above the balance and accelerate. In this case, it looked above the balance and accelerated. And, it was more than these whole 4 periods. Now, let's talk about the different personalities that could do this order. If you are a overthinker, this is not a good trade for you to do. You say, oh, well, let's see what happens. Oh, it doesn't look very good. It broke out. I'm going to stick around. If you're going to think like that, that's not your trade. If you are a quick thinker and you're willing to act quickly, you say, okay, I'm going with the breakout, and it either shows me something pretty quickly or I'm out of the trade. And when the trade comes back into the range, at a minimum, you're out. So again, it is so dependent upon your personality. Some people are looking for 2 to 3 trades a day, like myself. Other people are looking for 5 to 10 trades a day. So this is a legitimate trade on the breakout, depending upon your mental makeup and what you're willing to do. Not only what you're willing to do, but can you quickly make a decision to come out of that trade? Good question. Okay. One more before we move on.
Did you have your lines drawn on your charts prior to the Pitt session? And intensive traders know from the report you did. Obviously, coming into Tuesday's session, we're going to have Monday's high marked. And Jim's been following that prior Pitt high down there and the upper distribution, the single prints included, that was marked as well. But do you have any comment in addition to that, Jim?
You want to be prudent about the references you mark on your charts. You don't want to overdo it. Let me give you an example. Coming in today, I certainly had the buffer marked, and anybody that is part of the intensive is already getting the daily reports, both the recap and preparation report at night, as well as the update in the morning. Just in case somebody's, the intensive officially starts June 1st. But as soon as people sign up starting May 1st, we are giving the 2 reports each day, as well as continuing on the one-way chat comments throughout the day. This is to best prepare people to get the full value out of the intensive that officially starts June 1st. So I will have the major references. Some people, when I look at their charts, they have marked every reference available. They've marked every past high, every past low, every past point of control, and you look at the marks they got on that sheet, and it loses any impact for me because there's just too much. I can always go out and find, oh, here's a previous high, here's a previous low, here's a weekly high, here's a monthly low, going back for a long period of time. That can be disastrous. You have to be prudent about previous day's highs and lows, double distributions, pullback highs, pullback lows. Those are always important. And I just use a term that just to make sure everybody's familiar with it. If you had a trend day and the market rallies and then the market pulls back late in the day and then rallies again, that pullback low becomes a significant reference. Why is that a significant reference? If we trade below there in the following day, that's the sign that the market has changed. Trading is about change. A rally high. So if the market is a trend day down and the market rallies before it breaks lower again, that rally high is a significant reference. If we trade back above that the previous day, it's an indication something has changed relative to the previous day. Trading is about change. Okay, let me go on if I may. Here's, we've talked about, there's just a couple more things that I want to talk about on yesterday. We walked you through the things that were important from the opening yesterday morning. Now, we don't come into any day blind. It's not like, oh, wasn't this a nice day and we got a good night's sleep and I'll just wait till the market opens. And once the market opens, then I will begin to trade. It just doesn't really work that way. We're always trying to be prepared as we come into the day. So when the market opens, I already know if overnight inventory was long or short. For example, yesterday, the overnight inventory was very long. It looked early on when I wrote the morning update, the market still would have gapped higher. So I knew that overnight inventory was long. Just as a refresher, overnight inventory is measured from the settle of the previous day. It's a very simple concept. If the settle from the previous day was at 10 and overnight trades from 10 on up, then overnight inventory is 100% long. We see that about 65% of the time there is a counter auction to adjust overnight inventory. We had a client tell us yesterday, I haven't traded crude oil for some time, we had a client tell us yesterday that crude oil has been adjusting approximately 82% of the time. So when I came into yesterday, I knew overnight inventory was long, I had the potential for a gap, and the market didn't gap higher. By the time we got to the opening, we were back within the upper distribution from the previous day. So when I open in the morning, I have long inventory, and since the previous day was long, the chances are pretty good I'm going to get a correction to that overnight inventory. Even though the market has closed the gap prior to the opening, that overnight inventory was not corrected just because we opened within the previous day's range. Now, if you will recall, what I said earlier is that the low yesterday morning was a single tick below half back from the previous day. So now I come in the morning, and this is where you really start to get an understanding and how you can compete against everybody else. I come in the morning, I know overnight inventory is long. What did yesterday's market do? It sold off in the first half hour, even though 6 times it went to unchanged. Now, when you have overnight inventory that has been long, and now that inventory is corrected, that we refer to that as old business. In other words, people that were long overnight, they have to get out of that position. That's old business. Short covering, if the market was short the day before, we get a short covering rally today, that's old business. So now, when the market yesterday morning, the example we're looking at here, when the overnight inventory was long, and you can see how long it was, because here's overnight inventory right here. We opened here. So I've got, and it's clearly not corrected because we didn't even trade below unchanged early on. So I've got long overnight inventory, the chances are pretty good that we're going to get the market selling off just to correct that inventory. Now, here's where the real thought process comes in. And part of what we're trying to do is get you to forget about price. Too many people, most people that are not profitable trading futures or stocks are not profitable because their orientation is towards price, not towards value and not towards understanding conceptually what's occurring. So yesterday morning, overnight inventory is long. When the market went down to a single tick below half back from the previous day, if I had a combination of new money selling plus old business, which was liquidation, I am not going to stop one tick shy or one tick below half back from the day before. It's the more potent combination is liquidation and new money selling. That is a very potent combination. That's the kind of thing that makes trend days. But when I come in yesterday morning and this market is 6 times around unchanged the first half hour, all I'm looking at is the liquidation of overnight money. I do not have a combination of new money selling and liquidation. If I had that more potent combination, I would have traded down through this reference very, very quickly.
Can you point to that, Jim? I beg your pardon, but could you point to that for a period? There's the half back on Monday's profile, that white line.
Right there.
Okay, separating the single prints pretty much, and then over an A period. Look
period,
at the split out one, the split out profile to the right of that. It's easier to see. Yep.
Okay. So now, within a very few minutes yesterday morning, we already talked about the lack of confidence. We already talked about one tick by the reference, but now I take it to another place, and that is that the overnight inventory was long, and all I got was a correction to overnight inventory. Had I had new money selling, which is always what we want to know, oh my golly, price is going down. Is this going to be a really big day? And I'm looking and I'm saying, no, I've got overnight inventory being liquidated, and if I had anything more than that, I would be through the half back from the day before and through the upper distribution from the day before in almost no time. No way would I have traded 6 times once every 5 minutes back and forth through unchanged. Now, that is, when you first start to look at that, you can say, well, I'm sorry, Jim, this is a little too complicated for me. That's too ambiguous. Well, guess what? The majority of people do not make money trading. If you want to compete with the professionals and make money, you have to take your game to another level, and you have to begin to internalize these concepts. So yesterday, all the things we've talked about, within the first few minutes yesterday, I was very settled, as I had a pretty good idea that I was going to have a rotational day early in the morning. And that took the anxiety level way down, versus if you don't understand that and you see the market trading off, a period goes down early in the day, oh, look, all these single prints at one time. So, wow, this could be a big day. I mean, this market could really break hard. Well, all of a sudden, then you get caught short. And that's how you get whipped around, because price would have misled you. But if you took a look and understand the context of which price was declining, you would have been okay and say, there's really nothing going on in here other than a little liquidation from overnight inventory. And we've also said one of the most important times that traders get misled is when a correction of overnight inventory, whether it be correcting long overnight inventory or short overnight inventory, misleads them. Yesterday, with the market price going down because of the liquidation of overnight inventory, it would have been easy. So, oh boy, this market's going lower. I want to be short. And you get trapped. And all it was liquidation. How do you know that it's no more than that? Because we wouldn't have stopped right at the we wouldn't have stopped right at the reference. We wouldn't have back and forth through unsettled multiple times. Again, when we do the intensive, and it's to do this over and over again and kind of guide you through it. If you went out to get individual mentoring, it cost you probably $25,000, $30,000 a month. That's not an exaggeration. And that's just not affordable for most people. So in a sense, when Julia came up with this idea of the intensive, we were doing seminars in a hotel in Chicago, and it was good. We got a lot of good reviews from it, but it gets kind of frustrating because you can't really show people enough live in just 3 or 4 days. You may be doing a great job of what's there for those days, but there's so many other things that take place. And also within a few days, you don't have a chance to really internalize the information. And it's the internalization. It's like I said yesterday morning, within a few minutes, I had a pretty good idea what at least the early part of the day was going to look like. That's extremely beneficial. And that's really where you're trying to get to. And that's really what we're trying to do with the intensive. Like I say, it's immersion because we get you immersed into the markets immediately. We start with the opening and overnight inventory every day, and we kind of work out on the ripple effects from there. Okay, Julia, anything else before I maybe move over and we go through today?
Yes, we got a question here. Yesterday's volume was increasing all day. How important was this information to you?
I didn't see that volume was pretty low, as I remember, for the total yesterday. I think the total volume was under 3 billion for the day, wasn't it? And I certainly
it might have been 3. I got to look at it again. I have to go to the training.
It may have been 3 too, but it wasn't anything. There was no significant volume that got my attention at all yesterday.
Yeah, yesterday it was 3.2, and today it was 3.0.
Okay. All right. Other questions before I go on to today?
How important is the monthly high? Are you looking at the S&P monthly high? If we could look at CQG maybe for a second.
Well, we already know the monthly high.
Yeah, but just how are you using that in your daily trading and your preparation work?
Well, I mean, usually we'll do that when we get today. We know that each day. Yesterday was a new high in the Pitt session. The all-time high is at 21.
32.5. Is it
in the electronic market, in the overnight market? We have written numerous times that
21.34. It's higher than that.
21.34, and never.
No, I'll look. Thanks.
Never since we've been doing intensives or webinars have we had an overnight high be lasting. And we've talked about this. I don't know how many times I've talked about it, written about it. That doesn't mean that you don't get meaningful corrections from the overnight high, but it's never been lasting. So right now, we made a new Pitt session high, which would be a new monthly high this afternoon, but we still have the all-time high for this auction was still made in the over-the-counter market, the electronic market for the S&Ps.
It's right there, Jim. It's the 21.34. Excuse me. Yeah. It's that right there on the chart, 21.34. Yeah.
21.34, and we didn't get that out today. So again, that's how I'm using it. Now, when we look at markets, when we do our homework and our preparation, we always suggest that you start with a monthly. And the reason we do that, when we prep for the intensive, we always start with the monthly because we want you to have a larger perspective and then work down. Too many people lose track of the bigger picture because they narrow in on minutia or very tiny things very quickly. They're comfortable. They're much more comfortable with that. And that's comfort. Nobody's ever promised that trading was comfortable. So we start with the monthly, and this has been very helpful because as people have gotten very negative on this market, you'll see that the low was 2037, 2039.70. So we've been one time framing higher. 1 month, we look below in February, we looked below the previous month was 1981.50. We looked below 1974. We stopped one time framing higher, and the market turned around and came back up, and we've one time frame. So when I look at the monthly, I said, it's hard for me to get terribly excited about the short side of the market. Okay, then we go to the weekly. We look at the weekly. So where are we right now? You know, we're right at the top of the breakout level, and we're going to be dealing with that tomorrow morning. Do we have an excess high coming into tomorrow? We'll be talking about that. Then we go to the weekly. Finally, we go to the daily to give us a closer look. And once we've been through the daily, the last thing we do to prepare is we look at the profile itself. Okay. So yes, do we mark weekly highs and lows, monthly highs and lows? You bet. Again, when we talk about this idea of change, when you get near a weekly high or low or monthly high and low, you have the potential for change. Trading is about change. Okay. Julia, before I go to today, anything else?
How about we just, if you can knock this out, how often how long should you keep a reference marked on your charts, short-term versus long-term? I answered him quickly to say that once a structural reference, like anomalies, prominent point of control, poor high, poor low, once those are, taken out or revisited or repaired, we take them off the board. But longer term, the daily bracket, those kinds of things will lead to those.
I basically don't take them off unless there is just some clear breakout that just takes us away from it, and it's just superfluous information. That doesn't mean that if we come back into that area, that weeks down the road, I will go back and look at that because it may be meaningful. But I don't. Once I look like I have a change, I don't carry it forward on my daily charts. Okay, I'm going to go over and I'm going to look at today. We've talked briefly about today. We came down in the morning. We started this presentation talking about the buffer down here, and talking about the fact that because of context, we didn't stay short in the morning. Yes, we got below this level, but the first half hour volume did not support this break. We kept coming back into yesterday's range, which is a terrible sign. As I said, I put out in the chat, if there's anything here, I would prefer to stay below yesterday's range. Well, you can go back up there one time, but usually if you do more than that, you're not going to get downside carry through on the market. Now, let's put some other information together. I also know that I don't have, this was the upside breakout last Friday from the Pitt session highs. And if this is a good breakout, normally your next balance area will be substantially above that. Yesterday it came down and it was only 2 ticks above it. Today we got back in it, and not only did we get back in it, we left a poor low, meaning no excess on the low. Now, just like yesterday, remember, yesterday we had a good low, but it was a weak low. We did come back yesterday. That is part of figuring the odds. That is part of figuring the odds of upside continuation. Okay, now today, the market got very fat, meaning reading from left to right. The Fed came out and was right here. So we were 1, 2, 3, 4, 5, 6, 7, 8, 9. Is that 10? Let's see. 4, 5, 6, 7, 8, 9. 10 wide. The market, after the Fed came out, the market came down, traded to the point of control, traded to the point of control, traded to the point of control, and all of a sudden it rallied. It rallied. They left an excess high. They came back into today's earlier range. Looked like we had a re-entry. It stopped at almost exactly the point of control, traded there. Then the market started again and marched higher. It did not get to the 21.34 overnight high made in the electronic market. Disappointed me greatly. Now, those on the chat, no, you saw the chat comment, and one of the chat comments I put out there this afternoon was if the market came back and traded at 21.2650, I thought there was increased odds for aggressive liquidation from there. The market went up, and here's several things that happened. These are the little things that are important. Initially, L period came down to 21.2675, just a single tick above the 21.2650 reference, a single tick. You've already heard me talk earlier about weak. That is a weak reference. When a market comes down to within a single tick, granted, where the market broke out from is considered support. So when it comes down and leaves a single tick, it hasn't broken support yet. However, to come back as far as this market had come back from the K period high at the 21.32 level, all the way down here to within a single tick and then bounce again a little bit, that is not a sign of strength. That is mechanical buying by the weakest of traders. At that point in time, I was pretty sure that we were going to merge, I call it closing this upper distribution, meaning doing away with double distribution. Julia likes the term, and I like what she's come up with. It says merging this distribution with this distribution. So close it and merge it is usually a fairly negative situation. It also qualifies as one of our signature trades on our worksheet. We looked outside of range or outside of balance.
Could you point to that, Jim, the I period from yesterday? You have a lot of lines there. You might want to right-click and remove references. Remove all references, and then we can just kind of... So the I period is yesterday's high, and we can't quite see the top of your chart. Maybe if you pull it down a little or make it a little smaller.
Okay.
Yeah, thanks.
Okay. Now, when I looked at this, I was not doing this exactly as we did on the worksheet. The worksheet would say when you looked outside of yesterday's range. My reference was right here. On the chat said the number I used in the chat was 21.2650. Said if we traded at 21.2650, I thought that we would see more aggressive liquidation. The reason for that is with the double distribution day, I treat each day as a separate day or auction. So when each distribution as a separate day or auction. So the closing or merging of this distribution was negative, and that was my place for a short. And when this market left, the one time it left a single print, came up here, I thought the handwriting was pretty much on the wall because, again, it classifies as a single print, weak reference. If I had any long-term buying in there when that market came down there, its long-term smarter money isn't going to wait for a single tick. Does it happen? Sometimes it does. But when we had some volatility, when that happens, a single tick, it's highly unlikely that that's anything other than the weakest of money trying to buy exactly at a reference, a single tick. And of course, the market did come back down through that and took us almost all the way down to the low. There was the low in L period, almost down to the low for the day. It did not take out the early morning low. I was actually a little disappointed in the break. This was very fat, very wide, the fairest price or point of control, which kind of corralled that break. This is the market currently trading 21.2050, so we're below the pullback low at this point in time. But where we are now, we still have a poor low from today.
We have several below too.
And yes, we have structural problems underneath here. But one more time, when we're trading right now exactly, the last trade, 21.2050, is exactly at the number that we were using for the breakout level. Again, very mechanical on this. I don't know what happens tomorrow. The fatness of this profile, this is 2, 4, 5, 6, 7, 8, 9, 10, 14 wide. Something that wide has a high probability of being revisited. There is an exception, and the exception is when the market is balanced. And this may have been a very balanced day. So I'm going to treat the low up to the top of the distribution as short-term balance coming into tomorrow morning, and I'm going to apply the balanced trading rules to that. But again, this is not an overall healthy market. There again, the all-time high as of this point in time was still made in the electronic market. Okay, I have not had one of those last since I've been doing this. That doesn't mean I've seen 10 or 15% breaks without getting there, but it's still going back. In most cases, it only lasts a few days or maybe a few weeks. But we have the potential. We have a new high in the Pitt session. We have a weak close when we close this distribution. So tomorrow, this is pretty much what we identify as a go, no-go level. If you get more acceptance back within the previous range, you know, you can start to do some damage. This prominent POC right there at 201600 was never revisited. So you talk about, you know, information that I'm carrying forward. That is clearly a piece of information I'm carrying forward. I have anomalies on a very strange day here. I'm carrying forward 2109.25. I have a poor low at 2103.50. I'm carrying that forward. So I have one poor low. This is not a good low. It's a good low because it's 2 ticks, but it's nothing to write home about. I have a poor low here. So I have 2 poor lows within this area. So again, I don't have a lot of confidence that the market, that the build to the upside has been anything other than emotional buying because the ECB decided to supercharge their program and front end a lot of their stimulus. And of course you get China stimuli, you know, it's this emotional reaction to these markets, and we have to live and deal with these things, but it's not on a good foundation. So tomorrow, when I come in tomorrow, I'm in a go, no-go level relative to the 2120 level, which was the same reference we used today. Okay.
Quick question, if we can look at that spike again in K period. We had a couple of, one, what do you make of the spike? And then we got Mike down in Texas asking, wouldn't it, the speed up and down and the excess and short covering, wouldn't that have weakened the market as it took potential buying power out? He's short off of that with that thinking. Plus, we had such a tight balance this week. Would you agree with that statement that, you know, that short covering there weakened?
Well, yeah, short covering weakens the market, and I'm not sure this was short covering, but it was also emotional buying. Oh, you know, the Fed's not going to raise the rates in June. Let's go buy the market. There's just some crazy emotional, non-thinking things going on in this market. When I say to anybody that's short, and one of the problems we come into some days, we get a position and we lose perspective because we think we've got the home run. Step one, we do not have the all-time high was made in the electronic market. That's a negative. There's only 2 ticks at the high, so this wasn't anything really to write home about. This all looks to me like all I see this afternoon is liquidation versus a more potent combination of liquidation and new money selling. Had I had a combination of liquidation and new money selling this afternoon, I would have gotten the outside day. I did not get the outside day. So all I had was liquidation from money that got too emotional and too long, too quick. So there's a lot of conflict going on in here. But remember, the same concept when I talked about yesterday, overnight inventory was short, and early in the morning, if there'd been anything more than just the correction of overnight inventory, I wasn't going to stop a tick below half back, a mechanical reference. Today, not getting the outside day and not getting the follow through tells me that all I had was liquidation, which brings up another very important point. This is another thing that we're writing up. I told you that the fast track document is a living document, so it will get added to. But one of the things that we talk about is any trader, if I ask a trader what the market did today, any trader can probably tell me what the market did today. A professional trader will tell you what the market could have done and didn't do today. And sometimes one of the things we're teaching is what doesn't happen is very often more important than what actually does happen. Now we'll see what happens tomorrow, but the fact I have definitely recorded the fact that we could have easily have gotten the outside day to the downside. The fact that we didn't get that outside day to the downside is a valuable piece of information to me because it tells me that my selling this afternoon was liquidation, not something that was more potent and a combination of new money selling as well as liquidation. Now we'll see what happens in Europe and overnight, but today it's not one of those things I'm going home short and say, boy, I got this thing locked. Certainly not in that case. I'd love to see it, but this is very fat and I only got liquidation. So what didn't happen? And it's another one of those things. When you talk about the mindset of a professional trader, which is another one of those things that we're trying to instill in people throughout the intensive, is that mindset. You know, don't trade on emotion, don't trade on price. Have a better, deeper contextual understanding what's going on. And one of those things is what the market didn't do. What the market didn't do is sometimes more important than what actually happened. Julia, other issues, questions?
Yes, thank you, Jim. We're addressing this in the fast track document, but just you're going to get it because you're asking, but just for everyone's benefit, the question is, does a poor low imply weak support? And we've answered this in the document, but basically a poor low, you can think of it in terms of time frames, because if a poor low in the day time frame suggests that the market may be getting too short. A poor high may suggest it's getting too long. However, we also know in the next higher time frame that same poor low suggests there's a lack of auction completion. We didn't see aggressive buying off the lows this morning. So it says that we're probably going to come back and revisit it, repair it. However, the problem is we don't know when it's going to come back. We've seen, if you look below in your profile charts, there's several poor lows. I think we're at one today. It's the third one in recent activity. So can't be too quick to look for that immediate repair and start trying to fade an uptrend. All trends are up right now. So, you know, better to be a little late than to lean into it in terms of just looking for repair and hoping it comes the next day. I hope that helps you, Steve. You'll see that in the fast track document as well. Do you want to add to that, Jim?
No. Very, very, very well said. So many times when traders will see like 1 week lower and they'll say, oh, it's an aha moment. They want to use that to go short. It's very seldom a single issue. It's a broader idea. One of the most important things is this idea of carrying information forward. Every time I say this, I'm overused it, but we go back and we talk about the last seminar that we did. It was in Chicago.
Actually, it was in October 2011. Time flies. But that's the one we recorded for the live market seminar.
For the live market seminar.
Fortunately.
And I walked in the morning and I said, this may be one of these days that the market opens weak and closes strong. And why would I say that? And because there was so much information that I was carrying forward. There was a series of prominent points of control the one prominent point of control may be just an accident. Two prominent points of control that haven't been revisited may be exponential. Just like the poor low here from today, the poor low going back to last week just before the market broke to the upside, that starts to become exponential, meaning that, one poor low might be -5. Two poor lows, might be -25. That's an exponential effect to it. But the importance of carrying information forward, when we walked in that day and completing that seminar, in the last 40 minutes, the market rallied 400 points. And it was, it was a freak. We got very fortunate, but it was that carrying that information forward. So you're always aware of what the potential is. So when I come, let's say the market opens lower tomorrow, okay? I'm going to carry forward that today that the all-time high still was made in the over-the-counter market, the overnight electronic market. I'm going to carry forward this very prominent point of control.
Can you slide your profiles down to the right and over to the right and down just so they can see all of the activity? So 2134 was the electronic high. You can't see it he's turned off his overnight profiles. Yeah, you don't, yeah. Mm-hmm. We have, I'm sorry, Jim, did you want to finish that thought? Go ahead.
Well, it's to carry that information forward. Now, let me just take it one step forward. Now, let's talk about what would be the ideal downside breakout tomorrow. The ideal downside breakout tomorrow would early in the morning revisit this very prominent point of control and then break with gusto to the downside. So you revisit this very prominent point of control. You no longer have to carry it forward, and then the market breaks to the downside. The market breaks to the downside without going there, then I've got to carry that forward. So that's awfully wide. The potential to come back there is high. Just as this on the lower end, 2116 hasn't been revisited. The potential to get back to that level is high. So you're always getting some conflicting signals in these markets, and I can sit there. If you put me on a in front of a panel and said, okay, pick a straw, and I wouldn't care if I had to argue up or down tomorrow. I can argue either for tomorrow, and that is where you really want to be. One of the things that we encourage you to do as we go through the intensive is develop 3 potential scenarios each day. The trader that gets in the biggest trouble is the trader that only has one idea. I think this market's going up. I think this market's going down. That trader is usually very deadly, and even if they do well today, they will generally get wiped out fairly quickly because it just doesn't happen that often. So we try and encourage you to have 3 potential scenarios each day and be able to, and some of those scenarios being counter to each other so that you have an objective view of the market.
Okay.
Okay, we're running close on time.
Yeah, just a couple of things. If you could slide that down. We want to look at value relative to yesterday. We have a couple of people commenting on value today. The market tried to go higher. We do have a higher high all-time in the Pitt. However, the value was lower. Do you believe that traders really were getting long and that the price was going one way, but value's telling us a different story?
Absolutely.
Yeah,
and if you look at the chat comments, I put a chat. I did several things on the chat comment this morning. Early on, and this is the benefit for people that are already getting the chat comments and already enrolled in the intensive. This morning, the chat comments, I kept saying, watch the structure develop on the profile, concentrate on value, and we said one of the things was, okay, visualize, when the market was trading in, say, the 4th period, I said, visualize what the profile would have to look like to get overlapping value today, visualize what it would have to look like to get overlapping to lower value today, etc. So, and that's part of the process. When you really start to internalize what's going on, you have some pretty good idea what it's going to take. So early this morning, I believe we were 5 wide in E period.
Yep, you made that comment. Yep.
And we were 5 wide in E period. I went out on the chat, and I don't remember exactly what I said, but it looked to me like this was a good place to get caught short. I mean, very tiny short, very tiny short. But you were getting wider up here, so the fairest price was up here. This is trading down here, and then you got a little short covering rally, and that's all it was. It wasn't anything major, but you're watching this structure throughout the day, and that will give you, as you learn to read structure, it will give you a tremendous advantage as to how to trade the day and what is realistic and what is not.
And,
okay?
Okay, yeah, and just to finish this gentleman's thought, because he's new in the intensive, but he's coming along really well, and he said, I got short at 21.30 on the return back inside yesterday's high. So if you could move that down, Jim, so we can see all of today. So he's doing the signature trade, breakout and fail. He's still short now, 21.30. My point is, he's made this comment about price going higher, but value is lower. I'm aware that we have a high that was made in the electronic session, but sometimes we have to prioritize what we're looking at, make this hierarchy, and make our moves accordingly. Does this logic make sense to you? So he's, like you say, we always have to hold, the sign of what is intelligence, Eric Fromm, is holding two conflicting views at the same time. So he's saying, okay, we got the all-time electronic high in there. We know it's probably not secure in the long-term auction, but I'm going to short it coming back in range. The signature trade. So he's just asking, is his thinking correct? Is he prioritizing correctly to see the value of today as a little more important, at least in the day time frame, although he's carrying this home for, as opposed in relation to the all-time electronic high still being out there?
Yeah, it's very important the value was lower today, and that's what we wrote. Now, let me say this, and again, all I'm talking about is from an odd standpoint. I would not have gone home short. I would not have gone home short. And why would I have not gone home short? One, if the market was more than just liquidation, I would have had the outside day. And an outside day only counts when you close below the day. Just trading there doesn't do it. It has to close below there. Secondly, the very prominent point of control. And there was a chance to put some volume in there, and it really didn't do it. So this is just a personal, all I'm saying is a personal choice that I would have, even if the market went lower tomorrow. The problem with this stuff is it's very hard to put a reasonable stop in overnight. Anyhow, but now you say, okay, if you're going home short, and you say, okay, what do you need for continuation? What you need, anytime you put a trade on, you then monitor for continuation. So for continuation, you need to see acceptance down below today's low and start to get a little easier acceptance back within the range prior to when we broke out to the upside. You want to get back down towards this 21.16 level. So you're always asking yourself, what do I need for continuation? Do away with price. Do away with where did I buy it? Do I have a profit or a loss? Take a look at the structure and say, what do I need to remain in this trade? All right, we're at an hour and a half. You got anything final?
Let's see here. We got a new high today at 21.32 quarter. Yesterday's overnight, another was new high at 34. Today's value is overlapping to lower. Seems that a lot of people are getting long at higher prices, value lower. Does it seem like we have to go lower from here to 21.16, 21.09, or 20.96 value from last week's sessions and get more balanced in the market? Or does it seem like the auction is getting older and older to you?
The auction may be getting older and older, but that's different than having been completed. I don't know what's going to happen for him. The markets can, remember, all trends remain up.
Yeah.
And again, you had a chance to get, you were at all-time highs from the Pitt session today, and the market broke. If you had any longer-term money really selling in there, you we wouldn't have fallen short of taking out today's early morning low. Do I like today's early morning low? No, I don't like it, and I think it should get taken out. But if I had really good, strong, longer-term money on the sell side on today's rally, I wouldn't be. I would have easily gone down and traded through and closed below the early morning range.
Jim, thank you. A quick question here about the NAS. We had an outside day in the NQE mini and closed towards the middle of the distribution. What does an outside day typically say about the next day?
Nothing.
Well, it can suggest continuation. If we look, an outside day in Jim's definition, which is different than a conventional technical definition, is look above a high. So this current bar goes above the prior bar, and then it closes below the low. Not just makes a low below the low, but the close of that current bar is below the low or above the high of the prior day.
And it has to be sufficient, not a tick or two, not a mechanical. It has to be sufficient to show you there was really something going on. I've seen some absolute disasters from people. Oh, it's an outside day, and they can't wait to go with the outside day and just get murdered the next day.
Well,
you got to look at.
Yeah, go ahead.
You got to look at the volume. You want it to have a substantial. Once you get below that high or low, you want to see something substantial take place, not just barely eke it out.
Right. And conventionally, in technical wisdom, you would say, okay, outside day, we should see continuation in the direction of the close, whether it was to the downside or the upside for that outside day. Doesn't always play out as neat and tidy as
but
that
I don't
might
pay any attention to that because I'm going to look at the context. I want to see what the structure looks like. I want to see what the volume looked like. Lots of people get trapped because, technically it's an outside day. Oh, boy, this means go short. Mm-hmm. Sometimes they're dynamites. Sometimes they're dynamite signals, but we showed you an example where a month stopped one time frame to the downside, no follow through. So you really got to take everything into consideration. All right, go ahead.
Just one more question. It's interesting. Do you consider the opening price more significant than the settle, or do you see any comments you want to make to him about that?
No.
You don't see the open as more significant than the settle?
Nope. I look to see, do I open in or out of balance? I don't pick, opens, closings. They're relatively unimportant to me. I want to know what happens. I want to know once I have the opening, I want to know if there's confidence. Do I go back and forth through that opening, which says it's low confidence, or do I have the opening and do I start to move directionally with confidence away from that opening? Those are the things that are relevant to me.
Jim, can you slide your chart down a little so we can see the high there? I'm curious if there was any big volume. I was getting ready for this when we were settling out. So there wasn't any big volume, someone hammering it up there.
Well, you got 9,000. You got 9,000 right here.
Yeah.
But you didn't have what we've seen where you get 3 or 4 prices where you've got some really meaningful volume.
Right, you don't see it. I was just curious.
More like liquidation than anything else.
Mm-hmm. Okay, well, people are very appreciative of the chat comments today, and thank you for that, everyone, for people getting those. And thank you very much, everyone, hanging in here, and we hope you enjoyed the presentation. And thank you, Jim, for taking the time and doing such a great job laying all this out.
And we'll have another. We have a second webinar that's presentation for the get people ready for the intensive. When is that scheduled?
Next Wednesday. Don't ask me the time, but look at upcoming webinars. And I think we're going to do a referral program for people. Bring in a friend. If you're already enrolled, we'll work something out. But if you're in the intensive, you're going to get that email as well. So be looking for the document, the fast track, and be looking for that as well if you have any friends you want to bring in.
Yeah, let's cover that before you send the written one out. We have a lot of times we have traders that they get in there, and sometimes they're fairly new, and they say, "Boy, this is interesting. I got a friend that might be interested." So what we're going to do, and Julie will put this out in writing. We've not done this before, I don't think, but if you refer somebody, we'll give you $100 and we'll give them $100 off. So that's we'd appreciate the mention and also to make it meaningful for both of you, and just a little softer for somebody coming in for the first time. And additionally, we'll do one more, and also don't forget the fast track document is another way to prepare for the intensive.
Right, and sometimes it's just helpful when you're on this alone, and then you go in and you try and learn and study with a friend, or and they're not into it, and you're just kind of on your own. It can be helpful to have someone to bounce ideas off. You're both on the same path, looking at the same things, helping each other out. Someone sees something, you see something else, you put it together. So we've seen that over the years where it's made a difference in traders' progress, their evolution overall. So we think we're going to do that, and we'll put that out to everyone. And if you're not in the intensive, think about it. Give us a call if you want to go over it. We don't know if we're having another one. We certainly don't want to say anything because that can get us into trouble. But given that it worked out with a lot of people wanting it here, and we did it before the real summertime comes on, if you're thinking about it, we'd love to have you. Okay, and you're always welcome to call us. And Jim's birthday is on July 3rd, so we're going to finish the day before, and it'll be a good summer, and we'll all be in a different place when we come out the other side. So give it a thought. And again, Jim and I want to thank everyone for being here with us today. It's great to have you all here. We had some fabulous questions, and it always contributes to Jim's presentation, so we appreciate that very much.
Thanks.
All right. Thank you, Jim. And thank you, everyone. God be with you. Have a wonderful evening or day wherever you're at. We'll see you back here next Wednesday. Bye-bye.